company failed. How did this happen? $20 billion lost. A global property empire shattered. Canary Wharf half-built. Banks calling their loans. Olympia and York dominated skylines and balance sheets. It owned towers, train stations, riverside land. It commanded credit. It inspired awe. It also hid danger. The Reichman brothers built the firm. They built trust. They built an image of iron reliability. They preferred secrecy. They preferred control. Their reputation became currency. They offered a very public bet. They promised London a new financial island. They promised jobs and rents and a skyline. They promised returns. They promised to deliver on their word. They asked for money. Banks obliged. Citibank obliged more than most. Citibank extended credit and tied itself to Olympia and York through complex deals. At its peak, Citibank faced roughly $18 billion of exposure linked to the Reichman projects. That number loomed behind closed doors. It went largely unchallenged. Personal credibility blurred the view. They started with an audacious plan, a derelict dockland, a scheme for an office city, a tower grid to attract banks and law firms, a project that depended on leasing tens of millions of square feet in a market that did not yet exist. They financed the works with debt, not equity. Short-term facilities rolled from bank to bank. Cross-guarantees circulated within a family of companies. Collateral moved among entities like chess pieces. The paper looked solid when the towers rose. The risk was elsewhere, in timing and tenant uptake. At first, the picture looked right. Sheer concrete and glass climbed out of the mud. Early leases were signed. Headlines called it visionary. Lenders relaxed. Confidence bred more confidence. The Reichman name served as a stamp. Citibank and others treated reputation like collateral. Then costs rose. Construction bills ballooned. Leasing lagged. Interest rates climbed. The economy cooled. Tenants delayed decisions. Rents softened. The long cash flows the project promised retreated into the future. The short-term obligations moved to the present. Olympia and York reacted with financial engineering. They pushed assets into swaps. They cross-collateralized holdings to support short lines. They layered guarantees. They moved debt between subsidiaries. Each fix looked like more breathing room. Each fix increased counterparty exposure. Banks saw smaller problems and reacted. They checked boxes and accepted new collateral. They accepted family reputations as a line of defense. Citibank relied on personal meetings and the Reichman word. Executives took assurances at face value. That faith delayed alarms. It also concentrated risk. Small cracks became visible. Covenant tests failed in quiet memos. Interest payments were met with new loans rather than cash. Auditors flagged complexity. Mid-level bankers grew uneasy. But senior bankers valued the relationship. They feared losing the Reichmans as clients. They feared reputational fallout. They rolled loans. The complexity multiplied. Picture a web of claims. One subsidiary promised cash that another did not have. One bank's collateral was the same building another bank counted on. When one lender sought payment, the chain tightened. The swaps concealed the true leverage. The public faced scaffolding. The lenders faced a blindfold. Then the shock came. A wider market downturn. A few headline bankruptcies. Short-term liquidity dried. Lenders grew nervous everywhere. Institutions reassessed exposures. Citibank and its peers began to ask for cash. The calls were routine at first. They escalated fast. Banks stopped rolling facilities. They demanded repayment. They pulled lines. The collateral swaps began to unwind. Assets encumbered several times could not satisfy multiple calls. The dominoes touched. Boardrooms turned frantic. Phones rang non-stop. Lawyers cleared offices. Cash could not be produced. The Reichmans attempted to negotiate. They sought extensions. They sought equity partners. Markets smelled weakness and closed ranks. Default followed. Loan documents were served. Construction sites fell silent. Workers packed up. Suppliers waited unpaid. Contractors shut operations. Employees who had believed in the project found pink slips on doorsteps. Assets were fire sold. Office towers and parcels were auctioned. Prices were a fraction of replacement cost. Lenders realized they would write down enormous amounts. The collective hit to capital structures reached roughly $20 billion when measured across projects and claims. Citibank's exposure proved severe. Its deference to the Reichmann's personal credibility delayed rigorous due diligence. That delay magnified losses. Where independent analysis might have limited exposure, trust multiplied it. The bank found itself on the hook for a loss far larger than any single loan it had planned to hold. Pension funds and private investors felt it. Small bondholders took haircuts. Contractors folded. Communities lost contracts and wages. Canary Wharf, the project built as a promise of work and wealth, became for years a half-built emblem of loss. Regulators arrived late. They examined the wreckage. They saw a pattern: opaque collateral chains, short-term liquidity funding, long-term projects, and decisions made inside a family culture that prized control over transparency. They saw banks that had allowed reputation to substitute for analysis. Lessons hardened into new practices. Lenders demanded clearer covenants. Banks tightened counterparty limits. Regulators pressed for transparency in structured finance deals. Development finance shifted toward higher equity cushions and more honest stress testing. The industry changed because one collapse forced everyone to face hidden links. But the change came slowly. The docks emptied before they filled. Many who lost did not get recompense. Former employees and small investors rarely saw the headlines that finally acknowledged the scale. Families that had once counted on steady employment did not easily rebuild. In the aftermath, Canary Wharf itself survived and later prospered. New owners completed towers. New tenants arrived. The skyline recovered. The human toll did not simply vanish with new glass facades. Lives were altered. Careers derailed. Trust in institutions diminished. The forensics point to a clear sequence. A secretive dynasty made a speculative giant bet. Financing was short-term and opaque. Collateral swaps masked true exposure. A macro shock revealed the gap between promises and cash. Banks that leaned on personal credibility found themselves overexposed. The empire failed. What happened? A company that had been treated as untouchable defaulted. Why did it happen? Because personal credibility substituted for rigorous underwriting and because financing structures hid real leverage. What changed? Banking practice and developer deals shifted toward transparency and stronger covenants. For developers, raise more equity and reduce short-term leverage. For bankers, never let reputation replace independent risk assessment. For regulators, require transparency in cross-entity collateral and better reporting of related party exposures. A former site foreman remembers the day the crane stopped. "We had been promised a city," he says. "They promised us jobs. They promised our kids would have work. All we got was a silent skyline and a stack of unpaid bills." A small investor says, "It wasn't just money. It was trust. We trusted their name. We trusted their word. That trust turned into a blindfold." The company failed. The towers eventually rose under new hands. But $20 billion is not only a number. It is jobs lost, contractors unpaid, pensions trimmed, communities shaken, and trust broken. How did this happen? Because people believed a name more than they checked the math.